tax advantage products in the country and serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Saban. And of course, with me is national insurance expert Eric Palmer. You can contact either one of us at our email address, thequest@brokersalliance.com, or call us 1-800-290-7226. That's 1-800-290-7226. And the second segment, we're talking about annuity-linked benefits into LTC, and I have a new twist for you. What twist would that be, you may ask? Well, I've noticed that some of these contracts now have this is really a cool idea. It's called, part of their contractual provision is bed reservations. I love this. Right. You know, a lot of people get sick in the nursing home or in a facility, and they have to be hospitalized. And then when they're hospitalized, they lose their bed back at the home. I mean, this sounds pretty cruel, actually. But you know, they don't know if they're coming back. They don't know if they need to keep it open. The nursing home has to keep up their bed count so they can keep their revenue coming in.
I think it's interesting to note, it's something that we actually, it's not quite common knowledge, but there's typically a waiting list at nursing home facilities. So right. There's somebody waiting for that bed, and if you're not going to lock it down, you're going to lose it, and then potentially be put in a position where you have no choice but to take your care somewhere else.
Listen, I could see that, if we were going to start building facilities, that would be a good thing to invest in, because the baby boom generation is a huge population.
Especially in the state of Arizona, actually. It's one of the states that actually is suffering the largest downturns in actual development of those facilities. And so it's a very significant question to ask, is my bed going to be there when I get back out of the hospital?
I feel like I need to promote. Get your reservation in now.
Right.
But wait. We have a twin bed. I mean, I just feel like it's a blue light special from Kmart,
Right.
But I like this because if I go to the hospital, my bed is held for me. It's part of the contract, and they're still paying. The facility still gets paid. It's just not coming out of my pocket. It's part of my benefit. I mean, I love that.
Right. It's part of the policy that you purchased.
Another thing that I really like about these new is this called respite benefit. Let's say you had somebody really working for you, maybe one of your sons, your daughters when you're older, or maybe a neighbor, or somebody that you're using your benefits to pay them because they're helping you so much, and that's great. It's been very loving and benevolent. But the problem is that even caregivers need a break. You know what I'm saying? Right. I mean, can you imagine? You're taking this person to the bathroom, back to the bathroom, you're feeding them, and you just need a little vacation. These policies will allow you to insert a licensed professional, not just anybody, a licensed professional, while the caregiver, whoever that may be, takes a vacation, basically.
Yeah, it's basically a temporary caregiver, and those scenarios are things we don't usually think about. You're thinking, well, I've got the benefit coming in, I'll be just fine, but we've got to remember that our caregivers are human beings, and they might need a break, and so we've got to make sure that there's somebody to cover that time that they're gone. And if there's very specific instructions involved, you're going to want to make sure that they're licensed caregivers, because you don't want just anybody coming in to fill in the void. And
I think the contracts actually call that it has to be a licensed provider.
Exactly.
Yeah, I mean, I don't think you just put anybody in there. But I like the idea of a respite, a time, give the caregiver a break, a time for a little R&R, so that they can get their cells charged again. And it really is true. I mean, when you think about people serving in nursing homes and other long-term facilities, they really, it takes a special person to do that.
It does.
And especially if it's a quality place. We're not talking about the horror stories you hear on television, but I'm talking about quality facilities with people taking care of. I mean, I've met some most wonderful people. We have a couple nursing homes that I've been in here in our town, and I'm just always amazed at the people who have such a heart for it. But as great as their heart is, they need a little break. So I like these two provisions, Eric, this bed reservation issue and the respite benefit for the caregiver. I mean, I just love that idea.
And we don't find those features in every policy, especially, we're talking about annuities today, policies that have these built-in features. Not all the products available have those two particular features that you just mentioned. So again, it's all about asking the right questions, especially for the advisors that are listening to the show. You've got to ask your clients, are these things important? And you also got to make sure that you're putting them on the table because like us here, you don't always think about those things, and neither does the client. So mention that those features are available and ask them how important they would be.
I was looking at this one particular one, and again, if you want to call 1-800-290-7226 and say, hey, send me the comparisons on this, happy to do so, as well as you can always write us thequest@brokersalliance.com. But I'm looking at this one in particular. This goes out quite long, and this is a 9-year benefit, which generally, I think the average, Eric, isn't like in the average like 5 or 6 years?
You want to make sure, and I think the common rule is that you want to make sure you're offering at least 4, because they say that the average stay, say, in a nursing home is about 3.2 years. So you want to make sure you're covering your client for at least 4 years. But you're right, the average in the industry is no more than 6, so a 9-year benefit is extremely powerful. Now, like anything else, because we're stretching the benefit over a longer period of time, it's not going to pay out as high on a monthly basis, but it's putting your dollars to best use, and that's what we're really talking about today. If you have money you're setting aside for long-term care, I mentioned it, I think, on the Monday show. Let's say that your chronic illness event is Alzheimer's. You know, individuals with Alzheimer's, on average, stay in the nursing home facilities at least 8 years. So a 9-year benefit would be powerful in that type of situation, wouldn't it?
Especially when we were looking at that, that was one of the lead issues. Dementia, forms of dementia.
Right, the cognitive side of the equation.
So that would be a concern because the body, the physical body in a dementia scenario is not really our problem. It's not a physiological issue. Dementia is physiological, but there's nothing else wrong. It's just the issue of Alzheimer's or dementia or onset issues. So 9 years, they're just extending this. And as we said Monday on our show, we're going to have to go to this stuff sooner or later. We have to extend benefits because people are going to be living longer. They're going to be maybe staying in a facility or having their home care taken care of at home at a longer period of time.
And we look at this, I think in Friday's segment, we're going to talk about standalone long-term care policies. But, you know, there's options out there to get past the 9 years. You've got a lifetime type benefit option out there. But with the annuity specifically, 9 years, that's on the long end, and it's good to know that contract's out there.
I'm looking also this withdrawal period that they talk about. Not all contracts, but you know, where it's 24 months for single annuitants, it's 30 months for joint. Do you know anything about that? I'm kind of curious about that whole scenario.
In terms of how long the withdrawals will take place?
Yeah, because, you know, I'm looking at the difference between a single annuitant and a joint annuitant.
And that's another one of those things that could vary by state as well. Some states will say that it's only 12 months instead of the 24 months on a single annuitant. It just kind of depends on where you're at. But they're saying that in the event that you have a joint payout, it kind of comes to stretching the benefit as much as we can. The term might not be as significant if you have another life on top of things that you're taking into consideration.
On these contracts, because it is an annuity. I mean, really, it is an annuity. If I trigger LTC benefits and I use them, let's say I use a lot of them, up to the max. Whatever's left, now my basis, whatever my basis was in the annuity, it's reduced by how much I use the long-term care. So maybe I don't care as the annuitant, but my beneficiary is going to pay a higher tax bill because I actually use this. But I say, so what? You know, I mean, what do I care?
And we get questions a lot. Well, what is the reduction of basis? Is it a specific number? And it's not. It depends on age and the actual product that we're using. But one of the more significant pieces that are actually used to reduce the basis is the actual policy fees themselves. The Pension Protection Act is allowing us to add those policy fees on there without incurring a taxation on the amount that's distributed out. But that also is reducing the basis. So if there's some money left over and it does go to a beneficiary, there's potentially a larger pool that's taxable as an ordinary income tax for that beneficiary once they start distributing that money to themselves. And again, that's a question for your accountant, but it's definitely something that you have to note.
I've noticed that the annuity, that there's a cap there, so they must have figured out an actuarial kind of break-even point on this. I noticed that most of the caps are right around, for non-qualified at least, right around $300,000 is your top-out annuity. So if you had something a little larger than that, that would be too much. They're trying to keep it under a certain amount.
The most amount in the industry so far out of the handful of products is right around 700,000, but the average is about 300,000. And again, that's because for the types of features and benefits that they're offering, they can only guarantee the claims paying capability based on the interest rates that they're also guaranteeing in the annuity itself. And in this interest rate environment, right now with a 3% guarantee on a lot of these products, you got to make sure that the fees that are built into these contracts for those long-term care benefits don't exceed the actual contractual guarantees that the insurance company's giving you on the annuities. So there is a balancing act there, absolutely.
When you're buying these, I notice you're buying this policy with elimination periods and the length of benefit, but they also have this thing, this continuation of benefits. What is the COB? You know, I mean, they use these languages, this an acronym, COB balance.
It's basically buying an additional pool of money, if you will. It's looking at the different ways that we can calculate the pool of money or the actual benefits that'll pay out. And so there's an option for a continuation of benefits, or that if I buy a 3-year benefit period, I can actually add on for an extra couple of years there a continuation of benefit feature that'll stretch the dollars out even a longer period of time. And there could be a reduction in the actual amount that's paid out to you when you get into that continuation period. But the idea is that what we've been talking about all week, people are living longer. You might need that long-term care payout more than just a couple of years. Yeah,
as we stated, I mean, some of these Cadillac plans go 9 years, which is unbelievable.
Right.
I'm looking at always trying to figure out, you know, let's say a person could qualify for what we talked about yesterday, which is an LTC on a life chassis, a life contract, and this would be an LTC on a annuity contract. You know, I'm always looking at you know, if you could qualify for both, which one would I go? How would I go?
It all depends on the source of the funds. If you have your funds currently tied up into an annuity contract that's existing, say you bought an index annuity 10 years ago, or you bought a fixed deferred annuity at some point along the way, you may want to explore the annuity option because you can't 1035 an annuity into a life insurance
good
policy.
Point. That's right.
So a lot of times you have to analyze both products and see where's the money coming from that we're going to use to fund this in the first place. If you can qualify for life insurance, and we have a product that, like we've discussed yesterday, that has the robust amount of benefits to it, I would certainly try to qualify for it, because the tax-free death benefit at the end, if you don't use those living benefits, you don't use the long-term care feature, you pass away, the beneficiary gets a tax-free death benefit. That's pretty powerful.
It's very powerful, and thank you very much, Eric. I really appreciate that. I want to thank you for being my special guest on The Quest today.
Absolutely.
Our sponsor, of course, Brokers Alliance, and America, where you can still go on a quest for financial freedom. So until next time, remember what the good Reverend John Wesley once said. Make all you can, save all you can, give all you can. I'm Steve Savant. Join me next time on my quest for financial freedom.
Quest for Financial Freedom is brought to you by Brokers Alliance, the premier provider of guaranteed and tax advantage products to a nationwide network of financial professionals. Need financial guidance? Call Brokers Alliance. You can request an email link of this webcast at our email address, thequest@brokersalliance.com, or call us 1-800-290-7226. That's 800-290-7226. And join Steve Savant next time on the quest for financial freedom in your lifetime.